Hey, how's it going everyone? It's Griffin here. So $1 million investment portfolio. That's a goal that many investors set for themselves, especially when it comes to real estate investing. But realistically, $1 million portfolio, while it might seem like a lot, is not necessarily what it used to be considering current levels of inflation, right? That's the exact same reason why a house in 1950 cost $10,000 versus now that same house could go for well above hundreds of thousands of dollars. Now, as an active real estate investor myself and having been in the space for the past 3-4 years now, buying, fixing up, sometimes refinancing properties, other times selling some of those off. Well, I'm actually just on the very cusp of making my first $1 million of equity in real estate myself, which considering the fact that, I started 3-4 years ago investing in a small duplex in my hometown with less than $50,000 of my own capital injected into this property business in the first place, we could say that things are going pretty decently. In fact, I haven't spoken about this very much over the past couple of months on my YouTube channel, but I currently have 3 massive projects on the go, huge value adds where when all of those projects are completed, I will be in the $1 million equity territory for my real estate portfolio, which is super exciting. And it's a goal that I've been setting for myself ever since starting real estate in the first place. In fact, I haven't made a portfolio update in a while. It is long overdue. So much has just been going on. I've since sold off a property, rolled all of that money into a brand new deal that's going to be absolutely huge with a partner. And that is by far the largest undertaking to date in my real estate business. So if you're interested in me making a full video about that, make sure to comment down below that you're interested and also drop a like. It really helps the channel out. So let's get into today's video. Also, thank you very much to Landlord for sponsoring today's video, but more on them later. Okay, so in previous videos, I've spoken about the wealth building pillars of real estate, right? Being cash flows, debt pay down from paying off your mortgage, as well as appreciation over time and forced appreciation through strategic renovations, right? These are really the basics of building wealth in real estate. And ultimately, regardless of the type of strategy that you're deploying, they will come down to a combination of these 4 pillars. So with this in mind, well, of course, there are then many different ways that you can go about making your first $1 million investing in real estate, some of which we will be speaking about today. Now, what I really love about real estate investing though is that you can either take a very active approach to investing like I'm doing, where you're actually treating it as a business, or you can take a much more passive approach where you're making all of your wealth in real estate through just holding onto property over time. So let's then first cover strategy number 1 to making that first $1 million in real estate, which is a more passive approach and is ultimately going to take advantage of cash flows, debt pay down through mortgage payment, and then also appreciation over time as you're holding on to the property. Now, because I know there's quite a bit of skepticism online as to whether or not this type of strategy is even feasible in the first place, especially considering the current market, let's actually dive into the financials of one of my past deals, which is a 4-plex. So as mentioned, the property itself was a 4-plex, so 4 units in this building, purchased it for $340,000. And at the time of purchase, it had rents of $32,820 per year. But we were quickly able to bring those rents up the market because there was some tenant turnover. And so at that point, the rents on a yearly basis were $39,420. Now, if you want more details on that, I'd highly recommend that you go out and check the full dedicated video that I made on that property. Now, the annual expenses though on that property, including the mortgage payments, were $23,640, meaning positive cash flow actually of roughly $15,600 per year. And that doesn't even take into account the equity that was being built on the mortgage of $8,000 in year 1, considering the relatively low interest rate on that loan at the time. Now, I've since offloaded that property for reasons I'll be discussing in an upcoming video. Make sure to be subscribed so that you can stay tuned for that upcoming video. But had I just actually kept that property for the long term, well, not only would have raising the rent immediately raised the value of that property to at least $500,000, but this would have also continued taking advantage of further debt paydown and average appreciation year over year for 10-20 years as I'm actually holding on to the property. And this of course can create some massive returns. So let's take a look at a concrete example of what that property could be worth later on. So this right here shows us what the returns of this property would have looked like had I once again held onto it for 20 years, right? Where average yearly appreciation was only even 4%, right? So we can see that at the end of the 20-year period, considering cash flows, considering appreciation as well as debt paydown, there would have been over $1 million worth of profit at the end of all that. Of course, course, before taking into consideration any tax implications, but still just with one property over a 20-year hold, we're looking at over $1 million worth of total equity, cash flows, etc. And if you're able to then, over that period of time, refinance the property, pull some equity out, purchase another one, and maybe have 3-4 rental properties that are completely passive, well, over time, you're looking at millions of dollars worth of equity in your real estate portfolio. So even though I usually speak about active real estate investing on my YouTube channel, well, even if you approach this from a much more passive investment standpoint, well, as we just saw, over time, as you're building equity in multiple different properties, you're then able to leverage these properties to buy more, creating a lot of financial momentum in your real estate business. It's like a domino effect kind of. And so this is really a clear example as to why being a passive real estate investor can still make you a millionaire over time. Let's now take a quick minute to speak about today's video sponsor, Landlord. Let's dive into Landlords Platform right now. So Landlord is an online web platform to help landlords as well as property investors manage, track, and grow their property portfolios. And we'll be taking a few moments here to go over their deal analyzer tool, which is really simple to use and completely free on one of their free accounts. That being said, the deal analyzer tool is only one of the many tools available within Landlords Platform that you can access for free. Some of the other awesome tools include a profit and loss calculator in terms of your entire portfolio, as well as managing your tenants and a bird's eye view of your entire portfolio's value, loan balances, equity, and so forth. This, by the way, is a test account because, of course, all of this information is sensitive, especially considering tenant information, but you can also classify all your tenants accordingly within the platform. Overall, Landlord is a really complete platform for landlords and property investors. All right, so when you first log into Landlords Platform, this is the dashboard that you're presented with, and it's going to give you information on your entire portfolio. Now, we'll revisit this later. What we'll concentrate on right now is the deal analyzer. So clicking on deal analyzer, it brings us to this page right here where you can input any property address to get preliminary information on a property. And I'm just putting a random property address here. Let's just say this one. I have no idea what that property looks like, but from here, we only need to input 2 preliminary values to get some information. So let's just say a purchase price of $600,000, as well as the expected monthly rent. We'll put that at $5,000. With those 2 values specifically, it is going to start pre-populating first-year metrics as well as long-term metrics after a 10-year hold. So in terms of first-year metrics, we're looking at net annual cash flows, cash-on-cash returns, gross yields, as well as even the cap rate. Now, in terms of long-term metrics, we have information such as the internal rate of return, long-term return on investment, equity, and so forth. Now, of course, every property's expected returns, though, are going to differ based on your own cash investment and the loan details. So this was pre-populated with a 35% down payment. Let's just say we put 20% down. Everything here is going to change adequately. Also, the long-term assumptions, right? Occupancy rate at 95%. We can change the holding period as well as annual rent appreciation if that's something that you want to include over your long-term projections. All of this can be taken into account in a really simple manner in order to give you a really good depiction of what type of returns you can expect on your property investment. So if you're a landlord yourself and you want to try out Landlord's suite of tools and platform, make sure to check out the top link down below in the description and you can start with a free account. Thanks again to Landlord for sponsoring that portion of today's video. It's truly through opportunities like these I'm able to continue making content for all of you to enjoy on my channel. So with that said, let's get back to today's video. Okay, so if you're like me though, and you don't necessarily want to wait decades in order to create your first $1 million in real estate investing, well, it's important that you then understand how value is created and added to property in the first place. And ultimately, this is really going to come down to improving the property financially, and then also, aesthetically, the look of the property bringing up to par, right? So number one is through raising the actual rent that the property is generating, because this is pretty much the income of the property. It's like a mini business. We need to remember that. And the second way is to actually raise the marketable value of the property in question. Let me explain what I mean here in a bit more detail. All right, so 2 rental properties that are literally side by side on the exact same street could actually have vastly different market values due to certain factors such as the condition, improvements over the years, total rent, as well as, on the flip side, total expenses of the property. Because remember, I like to tell people to view every single piece of property as like its own mini business, right? Because every single one's going to have its own set of characteristics as well as has its own financials that make it more valuable or not in the market. Now, to understand how all of this works though, we need to dig into a little bit of math, but I promise this is not the type of math that we saw in high school. We can leave calculus at the door. Real estate math is fun. Okay, so I said two different rental properties that are side by side could very well have vastly different market values, right? Why is this in the context of real estate investing? Well, this ultimately comes down to the idea known as relative value, where based on factors such as financials as well as location in this case, well, we can equally compare two different rental properties. And the main metric here is what's known as the cap rate, which is short for capitalization rate. And this is a metric that we can use to compare two properties from a financial standpoint. So the cap rate, once again, short for capitalization rate, is pretty much a formula used in real estate investing to equally compare two different rental properties from a financial standpoint. And the formula to get the cap rate on a property is really simple. Here's what it looks like right here. Ultimately, we take the property's net operating income and we divide that by the market value of the property. This gives us the cap rate. And quickly here, a property's net operating income is essentially what's left over from a property's income after paying for all of the expenses of the property, not taking into account though the actual financing cost of the property, right? So any type of mortgage payment, because from one investor to another, the mortgage payment as well as any other type of financing costs can vastly differ. So really with the cap rate and the net operating income, we want to look at two properties equally from a financial standpoint, just from the property's income versus the operating expenses. Ultimately, this really just allows us real estate investors to look at two properties and compare them on an apples to apple comparison standpoint. Now, the idea with a cap rate though is that ultimately any type of investor, regardless of what you're investing in, expects a certain return on their investment, right? So when it comes to real estate investments, well, based on what you're purchasing a property for, a cap rate gives you a relative idea of how much you're going to be getting back on your investment. So this of course can differ on the type of investment, so the size of the rental property in question, whether or not it's a duplex versus a 50 unit, and it can also vastly differ depending on the location and geographic area of where you're investing in. Okay, so here's an example. Let's say you purchased a property for $500,000 and that property had rents of $28,800 per year, and the expenses of the property were say $7,200, again before any financing costs, right? And this is a neighborhood where that sells for average cap rates between, let's say, 4 and 5%. Well, this means that the property has net operating income, NOI for short, of $21,600 per year. And then if we divide that value by 500,000, well then this means the cap rate was 4.32%. So this really is where things get interesting, because knowing that a given property has a cap rate of say 4.32% in an area where cap rates are 4 to 5%, well now you're able to compare that property deal to any other property in that area and see whether or not you're getting a good deal or not. If you're a stock investor, by the way, you can think of this sort of as like the price to earnings ratio of a given stock, and various different industries will commend certain price to earnings ratios that are average based on characteristics of those industries in question. So ultimately what you need to remember here is that average as well as just acceptable cap rates on a property are going to vastly differ depending on the type of property you're looking at as well as the geographic area. So in the previous example though of the $500,000 property that had a cap rate of 4.32%, well, if you know that the units are being completely under rented, right, and they could actually be brought up to say $1,400 per month, considering that this is like a duplex, and by the way, I'm not advocating for like price gouging or anything, but just bringing up the market rent to actual, well, yeah, market value really, right? Because there are many property investors that may be holding onto a property for 10, 15, 20 years, and they never end up raising the actual monthly rent. So this is not only leaving a ton of money on the table for them when they're liquidating the property, but it also means a lot of opportunity for us as investors getting in on these deals. In that example though of the duplex, well, that would mean $400 in extra income per month or $4,800 in extra income per year, right? And this might really not sound like all too much, but when you're looking at this relative to how this increases the property value, it is actually monumental. Let's take a look right now. Okay, yeah, so an extra $4,800 per year that this income property is bringing in ends up bringing the total rent to $33,600. And if the expenses actually end up remaining the same, which they very well could, well, this means that the net operating income is $26,400, right? And based on your own purchase price of that property at say $500,000, this means that this brings your own cap rate on that property up to 6.72%, making it a much better investment for yourself. But it actually doesn't even end there, right? Because in regards to the market value, the new market value of that said property that you've improved the rents on, well, even at the cap rate of 4.32%, which is what you purchased it for, and again, let's say in that hypothetical example is average in that area that has cap rates of 4 to 5%, this would mean the new market value is $611,000, which is $110,000 more than what you paid for it. So how does all of this come back down though to making your first million? By the way, this is exactly what I've done to all of my rental properties since starting, and is really why I've been able to create a lot more equity fast rather than exclusively taking advantage of the passive, opportunities that real estate provides, being again those cash flows over time, the equity pay down, and so forth, right? By actually actively working on the business, raising rent, but then also adding units, which we didn't really speak about in today's video yet, but adding units, actually renovating them, and then refinancing them, well, they're worth a lot more in the eyes of the bank, but also the eyes of the market. It might sound overly simplistic, but if you want to add $1 million worth of equity to your real estate business, this pretty much comes down to adding $1 million of value to the properties that you're purchasing, and this comes right back down to the cap rate of the property. In fact, let's look at an example, right? So $1 million worth of equity, if say we were in a 5% average cap rate market, well, this means multiplying that $1 million of equity that you want to create by 5% cap rate, meaning increasing the net operating income, in this case, by $50,000 across all of the units and properties in your total portfolio. But this is per year. Let's remember that, right? It's not per month. So this means raising the net operating incomes by around $4,200 per month, again, across all of your units. Now, obviously, increasing your property portfolio by $4,200 worth of net operating income per month is not necessarily going to be feasible with 1 or 2 units. And that's why having many different rental properties really comes into play here with this strategy of creating a lot of equity. Ultimately, the larger your numbers are in terms of actual units, as well as even units in 1 or 2 deals, or just scaling your number of deals, is how you're able to create a lot more equity over time in your portfolio. And so since everyone here starts small, right, with 1 or 2 deals are typically going to be small multifamilies, we're not jumping straight into 30, 40, 50 unit buildings. Well, this is why scale of the number of units and number of properties really becomes paramount in this strategy. And I'd like to leave you with another thought here, right? So over time, as I've purchased many different properties and initially was really banking on long-term growth of these properties, I kind of quickly realized how much you're limited and how capped you are when you're just only exclusively relying on cash flows and debt paydown and long-term natural appreciation. So that's kind of why I've changed my strategy over the past couple of years, where now I'm really looking to add a lot of value as much as I can to these units, and also increase the amount of units in a given rental property. So this is something that I'm currently doing on 3 different properties. And so, for example, if one new unit is costing me, say, $75,000 to build, but this is then adding $15,000 worth of net operating income per year to that building, well, all of a sudden, in, say, a 6% cap rate market, that's increased the building's value by over $220,000. That's something to think about. Real estate can really seem overly complicated, but all really just comes back down to the relationship between income, expenses, and then the market that you're investing in. And so really that drives home the point of why I view real estate as an active business rather than a long-term passive investment. However, you can really approach it from whatever actual manner works best for your personal situation. Also, really just keep in mind that every single geographic market is going to have different cap rates, different market rents, different expenses, and so forth. So just make sure that you really fully understand the market that you're investing in before jumping in, right? I really hope you enjoyed today's video. If you did, make sure to drop a like, subscribe to the channel, make sure to comment down below as well if you have any questions about this. I'll be sure to answer any of the questions that you might have. Now, thanks again to Landlord also for sponsoring today's video. Highly appreciate it. Check them out if you're a landlord and you're interested. I'll have a link down below in the description. On that note, thanks a lot for watching today's video, and I'll see you in the next one.